In this lesson, we're going to talk about risk management. Risk management when trading and investing is extremely important. There's a reason why so many people fail in this business, in this career, and one of the major reasons is risk. They don't know how to manage risk properly. So I'm going to go outline many different categories on how you can manage risk, right? The first one that we already looked at is position sizing, or specifically limit orders and market orders. That's also managing risk, right? Deciding which entry order you're going to be placing, whether you're going to be entering live with market order. That is literally managing risk. You making that decision, you're managing risk. And now there's many other ways that you can manage risk. There's also correlation risk. As an example, and I'll expand more on correlation risk, that is, you might not want to place two long CAD positions, Canadian dollar positions. You might not want to buy two Canadian dollar or place two Canadian dollar trades. You might only choose one. That is also managing risk. Another way to manage risk is not risk your entire account. This is also one of the main reasons why people blow their entire trading account, is they risk too much. They put too much of their capital on the table on every single trade. What I mean by that is specifically when you're trading Forex, as an example. Depending on where you live in the world, leverage in Forex can be pretty high, anywhere from 30 to 1 to I've seen leverage as high as 500 to 1, meaning that for every dollar that you put down, you can trade a $500 position, literally. Right? That is a lot of risk. If somebody utilizes that entire leverage, right, on a single position, that is a lot of risk. They're pretty much risking not a dollar, they're risking $500, right? So it's very easy for somebody to blow their account by risking too much. So one of the main things that, again, I'll talk about is just risking 1% of your account size and not 3 or 5 or 10 like some people do. Right? That is, again, risk management. Risk management can also be related to news. You might not want to be placing positions during high impact news announcements, such as rate announcements and so on, right? You might want to wait for those announcements to conclude and finish and then take the live position or so on. So managing risk is one of the most important things that a trader can do. And I like to say that we're professional risk managers, literally. We're professional risk managers. Everything that we do is we're managing risks and we're trying to eliminate as much risk as possible. And there's many ways to do that. One of the ways is obviously doing proper technical analysis, multi-time frame analysis. When you do multi-time frame analysis, you're slowly eliminating risk because you're waiting, making sure that every single time frame, daily, 4 hour, 1 hour, we can even go higher, monthly, weekly, daily, 4 hour, 1 hour, making sure that all those time frames are aligning with your bearish or bullish bias. That is also managing risk, right? So that is why traders, one of the main things that I like to think about when I'm placing positions and so on is that I am a professional risk manager, right? And that my number one priority is preserving capital. It's not making money, which is obviously a key when you're trading and investing. Your goal is obviously to make money. But if you approach it from a point of view of preserving capital, you're going to focus on the best opportunities that you can get because you're eliminating as much risk as possible because you want to preserve your capital. You don't want to blow your entire account on emotional trades or trades that could be eliminated and so on, or by oversizing, risking too much. You want to eliminate as much risk as possible. So that's it for this kind of risk management introduction. In the next few lessons, I'll talk a little bit more about risk and how you can manage it. So I'll see you in the next lessons.